Hi, Jerht Santos here of the Coach PH. Remember to click the subscribe button to be updated with our latest videos. We divided our interview with PhilInvestor into 4 parts. In part 1, we will discuss how PhilInvestor retired at 50. In part 2, we will talk about PhilInvestor's buy and sell rules. Part 3 covers PhilInvestor's risk management principles. Part 4 will be about PhilInvestor's advice for newbies. Hi everyone! Welcome to the first episode of Market Masters. Our guest for today is no other than PhilInvestor. He has been in the financial markets for 35 years now. He applies both fundamental and technical analysis for his investments. Incidentally, he is the father of my high school classmate. One of the stories that he fondly shares is how his JFC investment became his children's educational fund. Without further ado, let us welcome PhilInvestor.
Hi, good afternoon.
Mr. PhilInvestor, I have a couple of questions for you. Can you briefly share how you got introduced to the capital markets?
Yeah, well, it was in '86 when I got married. And on the first night as husband and wife, we came up with a list of 30 items which we want to accomplish while we are married. And so one of the things I wrote there was to retire at 50. So I was being very idealistic. I was 27 years old at the time. And so, and then being an actuary by training. And so what I've done was that, okay, made some calculations. These are my expenses right now. Inflate that by the time I reach 50 and assuming I will live 25, 30 years, I have various scenarios. How much money do I need? And assuming how much money will my investments make? So I made those calculations. And early on, I saw that, okay, this is the number I need. So how much do I have to set aside regularly? And realizing at the time that if I kept my money in traditional banking products, there was no way to reach my goal of retiring at age 50. So I explored alternatives. And remember, this is 1986. We don't have the mutual funds. We don't have internet. Computers I'm using there was PC-80, PC-XT. There was no Excel spreadsheets. We were using Multiplan, where when you have to recalculate, you will have to press and then you wait for 5 or 10 minutes before the calculations are over. Not like right now, you press any change in your Excel spreadsheets, it automatically updates in a split second. So those are the times, and so I realized that I will have to explore other alternatives. And what came to my mind was that stocks, because I was pursuing my MBA. I just finished my MBA at the time, and so my electives were into finance and investments. And so I said, well, let me try my hand on investing in the stocks. So that was how it started.
I remember in our time together before, you also mentioned that you started with 16,000. Is that right?
Drill, I think several times I got in at 03. Buying was 03 for overseas. And for San Miguel was, I think, 109. And then, it went up from 03 to 039. I got out. And in a couple of days, it went back to 03. And I thought it was a lucky number. My first trade with overseas. I went back in. It was 03, 039. I did it 3 times. So that's 30% before the fees and taxes. At the time, remember, there was no online trading. For retail investors, we had to pay 1.5% brokers commissions going in and going out. So it was not like today, you can get much, much lower than what we used to pay as brokers commissions. And San Miguel was just doing from 109, I think it was 114. So time I said, well, maybe it's a good thing to be investing in oils because, more money on oils. I remember a day when I had losses equals to 3 months worth of my salary because I was heavily invested in oils. That was the time I realized, oops, investing in stocks was not an easy thing. So I had to learn a lot, read a lot of books, look for mentors, and that was how I got started.
Thank you for sharing that, Mr. PhilInvestor. You mentioned that you started when you were 27 and then you were planning to retire by 50. So you had 23 years to be able to retire. May I ask, what was the assumption or target rate of return per year when you started doing your computations?
Yeah, even at the time, I think what I was using was that treasury bills. At the time, we didn't have 10-year bills, if I'm not mistaken, just up to 1 year. And so 1 year treasury bills, less, of course, the final tax of 20%. That was, and then I adjusted it because I know interest rates move in cycles. They go up and they go down. I can't use that for the longest term. So I think I deducted 200 or 300 basis points. So that was the first assumption that I had. in terms of my yield. Remember also at that time, interest rates were double digit on a gross basis. It's not like today when you have 10-year bonds at very low single digits. No? So I think a 10-year bond right now would be 4.5%. It was much higher before. Now, if you're going to use the same calculations, I would probably have based my returns on 3% because, on a gross basis for a 10-year bond, that's 4.5, take away the final tax and make some adjustments, then maybe 3 to 4 will be already something that will be more realistic. And also for me, I'm an actuary. I would rather err on the conservative side rather than be aggressive and not meet my goals. Going to investments, you have to balance your aggressiveness for return and your attendance towards the risk that you are faced with when investing, especially in equities.
At that time, that was the risk-free rate. Is that right?
Yes.
For investor.
Yeah.
So
Yeah. I had to bring it down even because I know interest rates will have to come down.
Right.
Net of tax from 1 year government security because we don't have long-term ones yet at the time, and then adjusted to be conservative.
So being a conservative investor, you were targeting this rate, and of course, you were not limiting yourself for that rate only. You're going for much higher, right? Were you able to achieve the target fund or retirement fund goal even before 50?
The target fund, the original target fund, yes, but I had to revise it because interest rates went down. By the time I was going towards retirement, I think interest rates have gone down by 500 to 700 basis points. But I'm now using the 10-year bonds. So I think in my final 3 years, I thought I made it already, but I had to recalibrate my estimates. And my magic number is what I call it. This is the number I needed to set aside so that without working anymore, I could just leave off with earnings of my fund using the same lifestyle that I had prior to retirement. My magic number doubled in the final 3 years. So I thought that I made it at age 47, but the number increased just before I retired because interest rates have gone lower and I had to adjust my yield assumptions moving forward.
Aside from investing in stocks, I would say that you were very heavy on stocks aside from other instruments. What were the other things that you did to make that plan a reality, the plan of retiring before 50 or by 50?
I realized already that over the long term, it will be equities that will be the main drivers for my portfolio. In fact, up to the time I retired, I never held bonds. I did not invest in properties. I only had my house, some land, but not really for investments. It was all in equities because, I had a simple thought then. I said, look at the richest Filipinos in the country. Did you find anyone who just invested in fixed income instruments? Sabi ng bangko, mag-impok sa bangko. But look at the top, the richest Filipinos, they did not get their riches through placements in additional banking products, fixed income instruments. It was more in going to business. I may not be an entrepreneur. I said, my thinking was that I can use my facility to read the materials, understand markets, and then ride on to the successes of these taipans, these entrepreneurs who have been tested. Their businesses have been in place for 10 years, 20 years, 50 years, 100 years. And that was my simple strategy because going fixed income, there was no way. I looked at the rates and I looked at the list of richest Filipinos. There's no one who just made their riches going into fixed income instruments. And I was not a businessman, but see, my point was that, there will be cycles in business, but as an equity investor, if there are bad times, the owners of Mega Mall cannot just say, well, we'll shut down the malls for the next 2 years and we'll just resume operations 2 years after. If there are some challenges like COVID, for instance, that malls are faced with a lot of challenges. But my simple thinking then was that I can switch funds. I can get away from real estate and move into other assets. Although much later on, I realized it was also about the asset class. I can move into even other classes other than equities. But that time I said, I can switch from one company. So I was trading companies and based on what I saw were the opportunities of that particular industry and those companies that I invested. So I believed I was more flexible because I had that ability to switch my investments from one company to the other. I was also lucky that I retired towards the tail end of the financial crisis. And so when I retired towards that end, markets were very low. And, retiring, you get a lump sum benefit. And then one of the rules my wife told me was that, well, not like in the past when markets are down, you can average down, you have a strong income flow. Now your cash flow is limited to what you already have. So let's put a limit in terms of your equity positions of 25%. And I said, all my life, from age 27 to age 50, I was not putting money in fixed income. And now that I have time to really manage my own funds, you want me to cap it at 25. But I realized that you can you have to diversify. And that time, I can't average down when markets are down because I won't have any cash flows anymore, having retired. And so I bargained. I said, let's make it 50%, maximum 50% in equities. But the market was moving up very fast, so I was still shifting, creating my own bond fund. At one point in time, I think I had 16 or 17 bonds directly held because I had to also diversify. I cannot put everything in one particular bond issuance of a company. I had to diversify. So I had about 17 direct bond holdings of companies that are mostly listed. Later on, I also realized I do a lot of talks about financial markets. And even before we became investment grade, 3 years prior to that, in my talks, I was already saying that the Philippines will achieve investment grade because you were seeing that the EBAT was put in place, which was the mother of all fiscal reforms, and you have an improving fiscal situation. And with my studies also, if you have debt ratios coming down, what normally happens is that you have an increase in the growth of GDP because less and less funds from government will be used to set aside for debt servicing, and that more and more could be used for supporting economic activity. So I saw that coming, and I told my wife, look, if we're going to indeed get an investment grade, I'm worried that when the maturities of my bond holdings come in it's all 5, 7 years at a time. Again, because of the tax position at the time. That time, our understanding, the banks were telling me, if you invest it 5 years plus one day, it's not subject to final tax of 20%. That was the understanding before. And so, I didn't hold bonds after retirement, which are shorter than 5 years and one day. It was mostly 7. I think I had some 10-year bond. But I said, when this matures, when these bonds mature, they will be reinvested at a much lower rate. And so that's the time I said, I think I discussed with my wife that we will have to also look at properties as investments for relatively fixed income because, over time, if there's a price, there's an adjustment in the prices of properties. Plus, if you're able to rent it out, then you will have roughly duplicated a fixed income instrument with an equity investment. After retiring, that was the only time I started investing in bonds, and then 1, 2 years later, building up my own property investments. But stocks remain there. Naging tatlo na yung components.
So before retirement, it was really either equities or cash? Was that your position?
Mostly equities nga for the longest time. Matapang ako eh. Kala ko magaling na ako eh. I went through that. The market went up to 3,300, then back down to 1,000, back up to 2,300, 2,400, then back down again to 1,000. I went through that. 1,000 to 3,800, 3,800 to 19,000, 19,000 to 9,000. I went through all those phases. No? So parang battle scarred and hardened lessons learned from equities trading.
Right. And it's really not a straight line. In hindsight, maybe you can say, well, it's 3,000 now, it's almost 7,000, right? And at one point it became almost 9, but it's really not a straight line, and you have to go through the ups and downs and the volatility and all that.
In 2007, I made a call. I advised financial advisors at the time. It was in June, just before the start of the global financial crisis. And I said, expect increased volatility. If you or your clients going to take it, go to the money market fund. 2007. People who know me will bear me out. That I said that, I communicated that to several thousand financial advisors. And so people, thought I was crazy because looking back, returns on bond funds were double digit. Return on equities for up to June 2007, the last 4 or 5 years, was averaging more than 20%. And I was telling them, go to the money market fund where the yield was less than around 1 to 2.5%. So, but again, succeeding events will bear me out that the returns on both fixed income and equities turned negative the following year. What I realized also, when we talk about investments, sometimes you also have to consider safety of your principal. There will be times that will be avoiding best for you to stay out. I'm just talking about locals, by the way. I never invested in assets overseas, not even currencies. I just stuck to what I understand better. But then, as I said, after retirement, actually the last 2 years before retirement, that's the time I started, switching. If I'm not too confident about the valuations on stocks, I would move to money market fund because we have now those kinds of instruments available. So I was switching sometimes money market and then equities, hardly bond funds. But when I retired, then I had to create my own fund portfolio.
That brings me to my next question. How would you classify your investment style and how did you develop it?
I asked my mother-in-law, what are good stocks to buy, and then I remember that day I read the papers. I think there were some oil discoveries or a search for oil in Palawan. So I said, okay, San Miguel will be one, and then I bought Philippines. That was the start of it. No basis. Also in my MBA, my term paper in finance was a study, an in-depth study of San Miguel. So I felt a bit comfortable understanding the business of San Miguel. And so I said, okay, 50% in San Miguel. That was the bellwether stock at the time, because it was really well diversified, practically a monopoly in most industries that they participated in. So that was the start. But when I lost significant amounts, when the oil drillings in Palawan turned negative, so that's the time I started, okay, there's more to it than just concentrating on one sector. And so I read a lot of books to understand fundamental analysis and eventually technical analysis. Also down the road, I had the opportunity to have been given the software MetaStock professional that does a lot of charting and indicators, technical patterns. You will have commodity channel index, relative strength index, demand index, moving averages. I even created my own formulas, exponential moving averages, a difference of two exponential. I did a lot of trial and error. Again, remember the times I was just using PCXT, PC80. These are very slow machines at the time. I would even encode daily the values into my software because we don't have all these softwares that are available right now from our brokers. Online, you have these charting tools. At the time, I was inputting the values daily, open, high, low, close volume for all the stocks listed in the exchange. I was doing that for years. And on weekends, I will do a lot of trial and error, look at all the relationships, volume versus price, and then all these indicators. I would compress data sometimes, not daily data, every 2 days or every 1 week, and try to see what kind of technical indicators work best for a particular stock. So it was really a long process. And then over time also, I attended, but much later, probably when I was about 40 years old, a seminar by Finance Manila. We had a speaker, I think, from a brokerage firm. I forgot his name. I clearly remember he said, success in trading in the stock market can be summarized by just 3 words: research, research, and research. Everything is not easy. You have to do a lot of homework. And at that time, I switched also to looking at disclosures on the exchanges. Again, remember, before we didn't have this online material, so we will not know all these disclosures that are now available to us. So I did all that. I read a lot more books. Then I read the plans and the annual reports of companies. What are their plans and programs? Not only that, because there are several industries, what I did was that I would invite friends over coffee, the power sector, from the energy sector, property sector, or sometimes fund managers, and we'll have coffee once every 3 months or so and discuss the outlook. So of course you will have all the brokers reports coming your way as well. So a lot of preparation as well. So that was how my trading strategies evolved. Started with fundamentals. I would say also reading a lot of books. Peter Lynch, Beating the Street, One Up on Wall Street, How to Make Money in Stocks, A Winning System in Good Times or Bad by William O'Neill. Those are the fundamentals books on fundamentals that guided me to my approach. Eventually, I said, okay, there's money for the long term based on the learnings from these 3 books. And then there's also for trading, using software that I had, plus all the testings that I've done. I can do technical analysis. I think if I could summarize that, I would like to think that basically for my real investments, because there's speculative portion also for my investment portfolio. It will be, there's a story behind each stock that I buy. Whether the story unfolds or not over time, something that can change my outlook on that particular stock. And then the timing of buying and selling will be based on technicals. So I combine both technical and fundamentals for my core holding. For speculatives, usually I would do technicals for my speculative investment.
So it sounds like, sir, that you use fundamental analysis to help you choose the companies to pick.
Yes.
And then you use technical analysis with regards to the timing of
Yes.
entry and exit. In the next video, we will talk about PhilInvestor's buy and sell rules. What was the turning point when you said, okay, this is the system that I'm going to follow until retirement and beyond that? To get a copy of PhilInvestor's book recommendations, click the links in the description box. Thank you for watching. Click the subscribe button and see you on our next video. God bless you!